money. Foreign investors want returns. And right now, both sides have a problem. Investors are pulling money out of emerging markets. India is dealing with a weaker rupee, volatile oil prices, and growing global uncertainty, which is why the government is now considering tax relief for foreign investors. The obvious question is, why would India give up tax revenue at a time like this? The answer tells you a lot about how countries compete for capital in a crisis. Let's start with the problem. Since January, foreign portfolio investors have reportedly pulled out a record 2.6 lakh crore rupees from Indian equities. When investors bring money into India, they convert dollars into rupees. When they leave, they do the opposite. They sell Indian assets, buy dollars, take that money out of the country. And when enough investors do that, the rupee comes under pressure. That's exactly what has happened. The rupee has weakened roughly 6% against the US dollar this year. Normally, that would already be a big concern. But India is facing another challenge at the same time. The conflict in West Asia has increased uncertainty around global energy markets. And that's a problem for India because the country imports more than 85% of the crude oil it consumes. If oil prices rises, India's import bill rises. And to pay that bill, India needs dollars. So think about what's happening. On one side, dollars are leaving because foreign investors are pulling money out. On the other side, India may need more dollars if oil prices remain elevated. That is the economic pressure policymakers are trying to manage. And this is where the government's proposal comes in. According to reports, the Union Cabinet has already recommended an ordinance to ease tax rules for foreign investors in certain categories of securities. The details are not yet public, but the direction is clear. For years, foreign investors have argued that India's tax regime has become less competitive. Capital gains taxes have gone up. Securities transaction tax continues to apply. And investors group have repeatedly asked the government to review these taxes. Why? Because global investors have choices. They can invest in India or South Korea or Taiwan or Brazil or simply park money in safer assets. Capital goes where risk and returns make sense. And right now, India appears to be signaling that it wants to remain an attractive destination for that capital. Now here's the important point. The government is not doing this because it suddenly wants to help foreign investors. It's doing this because it wants the dollars that come with them. More foreign investment means more foreign currency entering the country. That can help stabilize the rupee, support financial markets, reduce pressure on government borrowing costs, and improve confidence at a time when global markets are nervous. In simple terms, policymakers appear to believe that the cost of losing foreign capital could be greater than the tax revenue collected from it. And this is not happening in isolation. In fact, the tax proposal appears to be part of a much broader response. Reports suggest the government is looking at multiple measures to shield the economy from the fallout of the West Asia conflict. Support for exporters is being discussed. Government-backed credit support for businesses is being also considered. Adjustments in duties are also being evaluated. And the government has already approved a 10,000 crore rupees package to cushion airlines from soaring aviation turbine fuel prices and prevent sharp increases in airfares. At the same time, the RBI is expected to announce its own measures following the Monetary Policy Committee meeting. Taken together, this looks less like a tax decision and more like a coordinated effort to defend the economy from external shocks. There's also a bigger lesson here. When people hear about wars, they usually think about geopolitics. When economists hear about wars, they think about oil, currencies, capital flows, and investment behavior. Because in today's world, money moves fast. A conflict in one part of the world can change where investors put their money. They can affect currencies, that can affect inflation, and that can also force governments thousands of kilometers away to respond, which is exactly what India appears to be doing. So what looks like a tax story is actually a story about capital. A record 2.6 lakh crore rupees has left Indian equities. The rupee is under pressure. Oil markets are uncertain, and policymakers are trying to ensure that foreign money keeps flowing into the country. Whether these measures succeed remains to be seen, but the message is already clear. At a time of global uncertainty, India is not just managing an economy, it is competing for capital. And in that competition, attracting investment may just be as important as collecting taxes.